Welcome to the podcast that will teach you how to successfully invest in and build steady streams of passive income from the highly lucrative niche of mobile home park investing. Veteran real estate investors Kevin Bupp and Charles Dehart from Mobile Home Park Academy will personally share with you the valuable lessons they've learned along their journey as mobile home park investors, so that you too can learn how to build massive cash flow and huge profits from this extremely lucrative niche. So without further ado, let's welcome your hosts for today's show, Kevin Bupp and Charles Dehart.
Welcome, guys and gals, to the Mobile Home Park Academy's weekly podcast, where we'll provide you all the information that you need to know to successfully locate, negotiate, close on, and make huge profits from the lucrative niche of mobile home park investing. I'm your host, Kevin Bupp, and today's show, we're going to be speaking with the CEO of Performance Equity Partners, also known as PEP, Scott MacNeil. Now, Performance Equity Partners is a residential mortgage lender who offers creative financing options to manufactured home community owners who need a funding source for individuals seeking home ownership. So, guys, I'm super excited to have a candid conversation with Scott here. But before we do, just have a few quick housekeeping items I'd like to run through. Like I mentioned, most shows, I just want to remind all that are tuning in that our company, Sunrise Capital Investors, we are in acquisition mode, looking for communities to purchase. And so, if you're out there in your hunt, in your search, or just happen to stumble across an opportunity that is 80 lots or larger in size in a good metro area, please think of us. We love paying huge finder's fees, and ultimately we'll pay upwards of $200,000 in a finder's fee for the right deal. You can reach out to us by going to our company website, sunrisecapitalinvestors.com, and just shoot us a message through the Contact Us link. And if you're looking for a way to break into the business, I know that a lot of folks are really seeking to get into the manufactured housing space. This could be a great way for you. So again, if you have an interest in maybe even being a finder for us, out there looking for deals, again, just shoot us a message through the sunrisecapitalinvestors.com Contact Us page, and we'll link up there. One other thing, just want to remind you before we get rolling here, we offer a free gift to all listeners that take the time to go to iTunes and leave a rating and review. And what we'll give you is the exact cold call script that we use in our very own business. And, over the years, the last eight or so years I've been in this business, we've purchased the majority of our portfolio that we own today from our cold calling and direct-to-owner marketing efforts. And so, if you're serious about getting into the business or, growing your portfolio, then I definitely advise you to actually start picking up the phone and actually reaching out to owners directly. And this script will help you get there much more comfortably. And to redeem that free gift, just send an email to gift@mobilehomeparkacademy.com. Just tell us who you are and what screen name you used to leave that review, and we'll shoot you out that free cold calling script. And so, guys, without further ado, I'd like to welcome our guest for today's show, Scott MacNeil. Scott, how you doing today?
Very well, Kevin. Thank you for having me on the program.
Yeah, thanks for being here. And just to give our listeners a sense of geography, where are we calling you at today? Where are you based out of?
I am from the home office right now in LaGrange, Illinois, which is in the western suburbs of Chicago.
All righty, good deal. So you're close to one of the ground zeros, but it sounds like far enough away. You're in the suburbs, so a little bit separated. And it's interesting to as we record this, we're in these really interesting times here, and one of the trends that I think will play out over the next 6 months as these, more densely populated urban areas start opening back up, the Chicagos, the Bostons, the New Yorks, that there will be a flocking of folks getting out of those high density areas, maybe more than likely temporarily, but looking to go to places like where you're at in the suburbs and maybe even further away, just to have that space in the event that there might be another lockdown or another resurgence of this virus come the fall time. So in any event, I'm glad to hear that you're safe and sound. Everyone's adapting to their new home office environment, and we're all learning how to use this cool technology of Zoom to communicate pretty effectively with the rest of our companies and the rest of the world. So things are good. Things are really, really good. So with that being said, Scott, thank you for coming on the show here. What I'd love to start with is maybe if you just take a few minutes and tell us a little bit about yourself and ultimately about PEP and a little bit of the background story and who PEP is and exactly what it is you do.
Right, absolutely. So Performance Equity Partners, or PEP as we refer to it, is a consumer chattel lending company. We're based out of the suburbs of Chicago in Tinley Park, Illinois. And we work in 14 different states offering solutions to mobile home park owners to help them finance buyers of homes in their parks, with the end result that they're able to increase their cash flow through increased lot rent. The company itself was started back in 2007, and it was an interesting story, actually. The 5 founders of the company and myself were all working at a local Chicago area bank that was under contract to be sold to Charter One. And it was a deal valued at the highest multiple ever paid for a bank in the state of Illinois at the time. And interestingly enough, we had a number of niche lending programs at the bank, and one of them was the chattel lending program. So the bank acquiring us was actually not interested in continuing the chattel lending program. So it was an opportunity for the 5 founders of PEP to go and form their own company and take the program and start running it separately as its own independent business. So that's what we've been doing for the past 12 years. We started in Illinois, expanded to the tri-state area, and over the past 12 years, we've expanded into 14 states, stretching from Utah in the west out to Ohio in the east, down to Texas, and all the way north to Minnesota. So we have a very strong coverage within the central United States, and we look to expand into other states as necessary where our customers and demand takes us.
Okay, appreciate that. And 2007, very interesting time to start a separate division. I mean, it was already a running division, right? You already had the business
Right.
model was in place, but obviously times are very challenging. You're running through 2007, 8, 9, and 10. And what type of challenges did your company face during those, I guess, very turbulent financial times, during the Great Recession?
Yeah, that's a great question. So interestingly enough, when they started, it was simply a matter of they bought the existing portfolio, they bought the existing furniture, fixture, and equipment, and brought it out, moved it from one office to the new office. Virtually all of the employees came over the next day. So it was rather seamless in terms of logistics and moving from outside of the bank, inside the bank group to outside of the bank group. And then, as you mentioned, a lot of things going on in 2008, weren't there? The Great Recession, the investment banks melting down, things like that. But interestingly enough, for our company, even though that was a challenging time in terms of getting financing for our own company, the mobile home portfolio performed very well. And I think that's one of the reasons that investors have flocked to this asset class recently, is because it provides a lot of stability even in good times and bad times. So the company fared rather well during that period. Obviously, you can still do a lot better when there's an economic growth period versus a recession. So we've been doing extremely well after that as well. But it was a fine time during the recession as well.
And just being that we have a lot of uncertainty of where we're going to end up over these next couple of years, I'd say, because I think the momentum that has been built up over these last 2.5, 3 months during the lockdown and basically the shutting down of our economy, I don't think we're going to see the end result or the repercussions immediately. Right, it's going to take some time for all that to play out. And I know it's not a apples to apple comparison, but the only thing that a lot of folks really have as a barometer is to kind of say, I remember 2008. And so do you recall what the default rate looked like during that period of time? Like what was the peak default rate on the chattel loans, given the volatility in that market?
I think we peaked somewhere between 5 and 10% at that time.
Got it.
And right now, we have the last couple of months have been very good and strong for collections because people have been receiving their income tax refund checks. Then they started receiving their stimulus checks. So we're expecting to see some increased delinquencies in the months ahead. But sales demand has been extremely strong for the past couple of months, while the state of Illinois and some other states have been aggressively closing things down, mandating shelter at home rules. A number of the other states that we do business in are quite active and have less aggressive shelter at home rules in place. So for the past couple of months, we've seen about 70% of where our normal loan originations would be for a non-pandemic situation, which is very good. And I think we'll see a lot of demand sort of whipsaw up after this ends.
Yeah, no, I agree with you. And just generally speaking, what is the average loan size that's made through PEP? Whether it be a new or used home, but just what's the average loan size that you make?
Sure, let me run you through the whole sort of average spectrum of things
please do.
there. So an average loan size is somewhere in the $20,000 to $30,000 range. We finance new and used homes. We don't care what the age of the home is. And so we end up with a loan direct to the consumer. We can amortize loans for as long as 20 years, but we don't like to go that long. We typically end up amortizing loans over 10 and 12 years. Mm-hmm. And again, that's on a loan size of somewhere between $20,000 and $30,000. We don't have a maximum loan size. We do have a minimum loan size, which is $6,000.
Got it.
So we offer a lot of different options. On the credit side, we don't have a minimum credit score that we look at. We look at the borrower's ability to repay. Mm-hmm. We do pull credit bureaus on everyone and underwrite in accordance with the ability to repay rules. And the important thing to us is to make sure that they have some sort of recent credit that they've been paying on with a solid pay history. So it's okay if a borrower has collections or even a bankruptcy. They may have some open judgments, things like that. We look at that, but again, emphasis is placed on their current ability to repay. Are they employed? Do they have some recent good accounts that they've been paying on consistently? That's more important to us than perhaps if they had some hiccups in the past.
Got it. No, makes sense. And as far as the, speaking to general terms here, what's the spectrum of interest rates, but also, down payments required and such?
Sure. So we price off of the average offered prime rate. We reprice weekly. Our interest rates have been hovering somewhere between, say, 10.5% and 12.5% recently. Mm-hmm. And that's probably what they've been on average for the past year or so. Down payments, we do have a way to do a 0% down program, but normally our minimum down payment is 5%. Now, if a borrower has been renting in a park for at least 12 months and they can demonstrate a solid pay history to the park owner, then we do allow a rent credit to be made for the 5% down payment. So that's how we are able to allow a 0% down program as well.
Got it. No, that makes sense. And I'd love to chat about the backstop guarantor. And these loans are obviously the guarantor being the park owner is going to backstop some of these less than stellar borrowers as far as the credit's concerned, and in the event of a default. And so, can we talk to the specifics of how that works? How long that backstop is for, in the event of a default, what does that situation, how does that play out, what have you?
Absolutely. So our program is a recourse program. That means that there is recourse back to the park owners. All of our park owners guarantee the loans ultimately. Yeah. So we do have a vetting process with our park owners in advance. We do request some basic information from them. And once we receive that, it takes us about a week to go through that and analyze that and get a dealer agreement and guarantee document in place with the dealer. From there, we're able to start accepting applications from people that they're selling homes to. So a normal process is we get a dealer set up. They get a dedicated mortgage loan officer assigned to them. And from there, we can start receiving applications. We will generally turn around an application with an approval in 24 hours or less. and we can generally close a loan inside of 2 weeks or better. We don't have an appraisal requirement, so we don't care about what the home has been sold for. It just has to be reasonable. So that cuts down on a lot of our closing timeline there, since we don't need any sort of appraisal valuation. So after that, we book the loan, and we have a loan direct to that consumer. We service that loan, we collect payments, et cetera, until the loan is paid off. Or if it goes into collection, we do all the collection work in-house. We have a team of 3 collectors that have combined experience in excess of 80 years collectively. So we do that in-house. And in 90% of the cases, we are able to, in a default situation, take the home all the way from cradle to grave, where we have possession of the home back. And it's at that point, when the borrower has vacated the building and we have possession back, that we then contact the park owner and say, okay, we have possession of the home back. Please pick a date at which you'd like to pay off the unpaid balance of this loan. And then the park owner will pay us off. We will return the title of the home back to them, and then they're free to sell that home again to another borrower. We could even finance a new borrower on the same home and take it from there. So we see that recourse occurs in about 8% of the loans that will come our way and that will fund. And that recourse, it is for the life of the loan. So in certain situations, if a park owner keeps the park forever and the portfolio, they rent up their whole park and the portfolio just burns off naturally, no problem. In other situations, park owners want to sell the park. Values have appreciated. They've built a lot of value through our program by increasing that lot rent, and now they're able to cash out. So in that situation, we will entertain situations to move the recourse from a current park owner to a new park owner. Now, there's no playbook on how that operates. Every situation's a little bit different, but we've certainly done it in the past, and it's certainly something we'll do in the future, and it just depends on the situation.
Okay. In the event of a default, is there an option for for the community owner to simply just assume that debt and start paying your company on the loan terms that are remaining?
That's a common question we get, Kevin. We're not really set up to do that. We like for the loan to have some finality to it. So we'll take it all the way to possession, and then we just like to make a clean break. And I think it's better for the park owners as well, because then they've got some certainty as to what will be happening with that home. Generally, they get the title back after they pay our company, and then if they need to, they'll renovate the home and put it back into the pool of homes to sell or rent. And at that point, they can sell it over again.
Yeah.
And generally, there's not a lot of money out of pocket when you look at it from that perspective, that the park owner receives the home back, they'll resell it again, we'll finance a new buyer, and it starts all over again.
Yeah, I guess a lot of it comes down to the the vetting process of your company vetting the actual community owner, and I guess I'm thinking, I always like to think of worst case scenarios and best case and try to find the happy medium, right? But in the event that a new park owner doesn't have a lot of a track record, maybe doesn't have a ton of liquidity, maybe happens to run to a default or two simultaneously, where maybe you've got $30,000 or $40,000 of debt that has to be paid off to PEP. They've got to have the liquidity available to do that, right, in order to get that title back and to resell that home. So, in any event, I'm sure that the answer to that would be you're going to vet these park owners and ensure they've got a track record, they've got a good decent balance sheet, what have you, and that they're in good financial health. Right.
Yeah, we'd like to be in as good of a situation as we were prior to the sale taking place. So we will definitely look at those considerations. We analyze it much like a bank would a commercial loan customer. So we'll look at a personal financial statement. We'll look at some current tax returns and liquidity. And again, we'd like to be in as good of a situation with the new park owner as we were with the old park owner, which makes sense. And we've been pretty successful in making that happen for people in the past.
Got it. What else haven't I asked you yet, Scott, that is relevant and would be of value to the community owners that are tuning in right now?
Sure. I think the key point is what our product is really used for. So if a park owner purchases a brand new home park, or maybe they even have a park they've owned for a few years, really, our program is designed for park owners to increase the value of their parks by increasing their occupancy, lot rent only. So whether it's a park owner has 40 vacant spots and they're going to bring in new and used homes and try to sell them, our program's perfect for that. So we offer very flexible terms, some of the most flexible in the industry in terms of borrower financing. So we end up approving a lot of buyers for a lot of homes in mobile parks across 14 different states. The other instance where it's really of value to park owners is if a park owner has a park with a lot of park-owned homes. Park-owned homes are generally viewed as a bad thing because you have a lot of appliances to fix, you're in the landlording business, and you've got a lot of capital sitting there in the park that could be used to buy another park. So we're really good when it comes to park-owned homes. When a park owner will put on a sales program and start selling those homes to either the tenants that are in them or people off the street, again, that's a perfect situation for our program. We can do a 0% down in some of those situations. Otherwise, it's 5% down. And again, with the flexible terms of our program, we can approve a lot of borrowers. So it's a good way for a park owner to free up capital. And you can do the numbers really quickly. If you have 10 park-owned homes that are worth $20,000 or $30,000 a piece, there's hundreds of thousands of dollars sitting in the park, and that's the size of a down payment on another park. So anyone that has used our program has had a great experience with it. So I really encourage listeners and viewers to go out and talk to other people that are in our program and get a feel from the park owners that are using it to really understand the benefits of it and how easy it is to get it going and how useful it is. So that's really what it is in a nutshell, is creating a source of liquidity for park owners through their park-owned homes, or else increasing the value of the park by increasing the occupancy.
Yeah, no, that's fantastic. I mean, that's the name of the game, right? To add value. And there's many communities out there, to this day that have the infrastructure there, that have vacant lots ready for used or new homes to come in. And that's been a challenge in this industry for quite some time, right? Since the crash of the chattel side of this business back when 1999, 2000 era, quite a long time ago. There's still not that many options today, and so this is a critical piece of the puzzle. If you're going to purchase communities, and if you intend to purchase communities that have vacant lots, and ultimately you would love to bring homes in and create a sales program there and fill up that community. The days of the consumers moving their homes in, it happens, and we've got communities in 13 states, and it surely happens. And I'm always jumping up and down when it does, but we would never rely on that to fill a community up. It just, it's not the name of the game anymore. And so, folks, if you're in the business already and you've got vacant lots you're looking to fill, you definitely need to check out PEP. Or if you're looking to get into the business and you're kind of hitting that stumbling block of how do you do that side of the business, well, this is a great option for you. And so, Scott, for folks that want to learn more about your services, the company, what have you, what's the best place to find you?
Sure, at our website, peplending.com. They can reach out to myself for the next steps. My cell phone number is 312-282-4430, or go direct to our website. It has all of my contact information as well. An email is smacneil, that's MacNeil, at peplending.com.
All righty. Fantastic. Scott, thank you so much for joining us and sharing all your insights. It's been very helpful, and look forward to staying in touch with you.
Great. Thank you, Kevin. Appreciate it.
All right, guys. Thank you again for stopping by and joining us here at the Mobile Home Park Investing Podcast. This is your host, Kevin Bupp, signing off. You guys take care.
Congratulations for taking the necessary steps to achieving massive success through the highly lucrative niche of mobile home park investing. Be sure to visit our website, mobilehomeparkacademy.com, to download your free digital ebook version of the 21 biggest mistakes investors make when buying their first mobile home park and how you can avoid them. And while you're there, be sure to subscribe to our free monthly mobile home park investing newsletter, which is jammed full of valuable tips, tricks, and strategies to help you accelerate your path to success as a mobile home park investor. More information about this podcast and its hosts can be found by visiting mobilehomeparkacademy.com.